Productivity growth will enable companies to raise wages, which without triggering cost push inflation, which turns into an inflationary spiral like we saw in the 70s. 70s, we did not see the productivity growth. It was terrible. We are seeing a pickup in productivity growth thanks to the accelerated shift towards the digital world, which is much more productive. So I think that this dichotomy between value and growth is going to, we're going to get two answers in the near term. The first is real growth truly inflationary? And we would submit no. Productivity, thanks to innovation, is one of the reasons it isn't. Therefore, interest rates are going to continue to surprise on the low side of expectations. And as you know, the long-term Treasury yield, 10-year Treasury yield, peaked at 1.75-ish at the end of March, and this week dropped as low as 1.12. Today it's up based on this employment report, and so we're having a good value and cyclical day in the market and a tough day for innovation. But I think as more and more people begin to understand that real growth, especially if it is driven by innovation, and increasingly we think it will be, that real growth does not have to be inflationary, and that interest rates do not have to go up. So if we get inflation coming down for the three reasons that we have been discussing with you over these last few months, the good deflation is innovation riding down learning curves, which are characterized by cost declines, which are passed through as lower prices. Think electric vehicles. We just learned today or this week that the Leaf with subsidies, its EV is going to drop below $20,000. I think the list price will be $25,000, but below $20,000. And even without subsidies, the price would be falling. So think of that. The cost of a car is going to drop, and we believe we won't need subsidies in a few years, is going to drop below $20,000. That is going to cause a boom. This is going to be the electric vehicle boom. And it has just started. The second reason we're going to see deflation is for a less good reason, and that's creative destruction. Disruptive innovation causes creative destruction. And we think that the problems in other industries that are disrupted by innovation are going to be worse because many of them have leveraged up to buy back shares and satisfy short-term shareholders who wanted their profits, and they wanted them now. So we think this is going to become pretty pervasive, good deflation and bad deflation. And then the third source of deflation, which is what we've spent a bit of time on here, is cyclical deflation. If inventories are piled up in homes, especially of goods, then we believe that prices will unwind and really take the inflation argument off the table and take the fears associated with higher interest rates caused by higher inflation away. And actually, what that will mean is that the bull market, which you think about it this year, think about what we've gone through. We've gone through the Archegos debacle. We've gone through a resurgence of the coronavirus, the threat of tax hikes, and now the fallout from China, which is the last topic I'm going to get to. And the bull market just keeps moving along. And so this this toggling back and forth recently between growth and value, we think will resolve towards growth as the cyclical dynamics of the economy turn much weaker than we've seen recently. And one of the biggest ones, by the way, was interest rates doubling in the first quarter. I couldn't believe that at the end of the first quarter, the market was up. So we're in a strong bull market. We really do believe that. Now, one last thing, capital may be flowing to our economy and other developed markets and maybe other emerging markets from China because of what has happened recently. The government is cracking down. It has strengthened its crackdown. It started with Jack Ma. We just thought that was a bit of a power play last November. But that was really the beginning of a number of moves having to do with data privacy, data leakage. Data leakage would be DD, which right after it IPO'd, the government basically, in effect, is trying to shut it down. Certainly not allowing any new riders, or no one can load the app. So it sent a loud message about data leakage and making sure to go right through the right channels there. I think China's making it clear that it's less interested in feeding the digital part of the economy and much more interested in becoming much more self-sufficient on the manufacturing side of the economy. But in describing what it believed had happened to the online education sector, it said it had been hijacked by capital. We know that China does want to become the largest economy in the world, wants to be the most innovative in the world as well, wants to dial down some of the mass media products and the inequity that has taken place. But I don't think it wants to shut its economy down. That said, one of the reasons we think cyclical deflation is going to surface here is we do think China is slowing down. And some of these measures will, I'm sure, hurt confidence over there and cause more conservative behavior, perhaps exacerbating a slowdown. So with that, I will wrap up here just by re-emphasizing we don't think inflation's a problem. And yet, everywhere I go, I tune into conferences, some of the finest name minds in the world, and they express puzzlement at why long bond yields have gone down and basically say it's just because of quantitative easing. Well, quantitative easing has been with us this entire time of rates rising from 0.5 in the depths of the crisis to 1.75. We think the bond market is seeing something different, and it is more deflationary undercurrents in the economy than I think most economists and strategists perceive. But we will see. This is what makes a market. And as I always say, I don't mind being on the side of an argument where very few others are. Because if the markets have not incorporated it in or discounted it, and we're wrong, then we're not going to be punished that much for having that point of view.